So have you been thinking about purchasing a home? Maybe you're thinking about selling and maybe moving up and maybe taking a little bit more of a mortgage out. Well, in this video, I'm going to go over the affordability, how much you can afford with all the interest rate increases on what we've been seeing. All right, so this is all a rule of thumb. I'm not a mortgage professional, so definitely you need to talk to your mortgage professionals about this. Talk to your professionals, but this is just a general rule of thumb, and it's the 1-10 rule. So that means for every 1% increase you see in interest rates, it's going to change your buying power of about 10%. So that means if an interest rate goes up 1%, what you could have purchased before for $1 million based on what your payments were, you can now only purchase for $900,000. So that is just a rough estimate of it. So this is important to get into if you are looking to purchase. And as we're continuing to see interest rates increase, the interest rates were increased last month, and the United States just increased their interest rates again a couple of days ago. So this is a very important thing to do. So if you are looking to purchase, it might make more sense to purchase right now, get into the market if you can afford it and if you plan to ride it out for the long term. I mean, we'll get into other conversations whether or not it's a good time. But there's also rate holds, what your purchasers, what your bank, your lender can offer you to allow you to hold the rate what it is today. And then you get the benefit. If the rates go down, by the time you make your purchase, you get the benefit of it. But it is definitely a great situation just to really know that rule of thumb, just so you don't get caught off guard. And maybe you're starting to get pushed out of the price range where now there's not any homes that you'd even consider. Or maybe you're looking to move up and now it's not making sense. So it's really going to adjust you and in your purchasing decision. So keep in mind that 1-10 rule of thumb. So for every 1% increase in the interest rates, it's about a 10% decrease in your purchasing power. And if you haven't already, hit that like button and subscribe to the channel of Living in Kelowna. And down below, if you are interested in the real estate market, I do have a weekly email for market information. I'm not going to spam you. You can unsubscribe at any time, but sign up below. I do have the links. But I have some tips for you right now. So I got 5 tips for you on how you can get around some of the mortgage rate increases. So even though you're getting pinched a little bit on your purchasing power, you might be able to get a little bit more room with some of these other negotiating tips here. So we're just going to jump right into it. So tip number 1 on ways we can maybe help you navigate around the increase in your purchasing power as rates continue to climb is number 1 is really making a larger down payment. So if you're able to put a little bit more down, you can get those payments down. So if you're thinking about putting 10% down, maybe it's an opportunity where you could put 15 or 20% down, or talk to your family and maybe you could raise an additional cash to be able to put another 20% down. So this is going to offset a little bit of the higher interest rate, but it's also maybe going to allow you to negotiate a lower interest rate based on a better overall ability to down payment. Each lender will look at it a little bit different, but that is a thought and just a suggestion, maybe something to look into if you do have that ability. Realize not everybody does have that ability, but look into it and just see if it might be an option for you. People are buying and selling real estate every day here in the Okanagan. And if that's you, if you're looking here, pick up that phone, give me a call. I have people call me every day looking to move here to the Okanagan, and people that are moving in and around the Okanagan right now. And so reach out, give me a call, and I'm happy to help you. Number 2, talk to your lender about this one, but maybe you can adjust the lending terms on it. So you can maybe look at an opportunity where instead of doing, an amortization of 25 or 20 years, maybe you can get a 30-year mortgage. And if you extend the amortization period out, you are stretching the periods, but you're bringing down the payments, which makes it a little bit more affordable than what it would be for the 25-year or a 20. So you can help build your equity a little bit faster. So number 3 is talk to your lender and how your credit history really looks. And if you don't keep on tabs of what your credit history looks, maybe there's a situation where maybe there's a missed payment or something like that. Maybe something's not recording properly, or maybe somebody has the similar name of you and they don't really have the best repayment period, or maybe they have a highly leveraged line of credit. Maybe you can pay down some of those credit cards, or maybe you can get some of that unreliable information on your system. So learn about it, make sure it's all correct, get that information from your lender just just to see what is on there. You can pull them. Equifax will do their own reports, and so you can really actually pull your own and get your own information just to make sure it's all accurate. You just want to be cautious how many times you're pulling it, because that can really affect your score, the amount of inquiries. And there's a thing called soft pulls and light pulls. So you want to just make sure that, you know, the pulls that you're doing, so when you're pulling your credit, that is not hitting the system as how many pulls, because that is a way you can really detract your score. And so that's going to take down your score, and then it's also going to have the reverse effect on your lending, is what we're trying to achieve in trying to get you a higher amount of lending possible. That'll actually kind of reduce some of the risk the lenders will take on by taking those additional pulls. So just be cautious on what you're doing. You don't want to pull it too much, but you want to make sure what's on file is actually all correct, and that it's indicating correctly. And maybe we can pay out some of those lines of credits or something like that. Maybe you can factor that into your mortgage where you can get overall a better rate. So number 4, and this might just sound, you know, stupid, or, you know, you might be able to do it, but, you know, obviously you still have to live, but limit your spending. So maybe this is a time, if you are buying a house, it's expensive already, and you're probably bootstrapping yourself just to get enough for your down payment, just for that 5%, and really struggling. But it is just be really cognizant and be cautious on what you're spending. Don't go buying vehicles, especially leveraging other loans, that sort of thing, before you close on a property. So mistake number one, what you can do is actually take out a car loan right before closing on a property. So limit your spending between now and when you take possession of your property, and really it'll just help out, save your savings, and just really help it area out. And if you are going to do anything, make sure it's cash, and make sure you still have enough over for all the additional costs that come with buying and selling real estate. And number 5 is really just making sure you're moving quickly through the process to save you the amount of money. And make sure you're, as soon as possible, you know, securing that rate hold. So if you're looking right now and you're just starting your process, talk to your lender right now, because interest rates are on the incline. It's probably better now to secure a rate today than what it will be in 2 months potentially. So secure a rate now, get in that conversation, and those rate holds are likely good for about 6 to 8 months type of situation. Everybody is different, but talk to your lender about that. And so really just get on top of it, everything, as soon as possible. And you can always lock in a lower rate. If what's the worst case scenario, if rates do go down and you can get a better rate, well, then you're already locked in, and then you can change your rate down the road. So you have nothing to lose really in locking in today. And if you don't buy anything, then you just continue on and you go on it. So it's not really an issue from that standpoint, but the longer you leave it, the harder it's going to hit you. All right, so there's the rules of how much you can afford with the rate increases that are happening right now in the real estate market right now, and some of the ways you can get around it. I know not everybody's going to be, you know, lucky enough to be able to get around a lot of these items here, but just some items that you can maybe hopefully help you, put you ahead of the pack, and really help you save some money down the road. And final tip for you, if you are looking to purchase new construction, lock in your rate hold right now, but you got to be careful, because one of the biggest issues what we're seeing right now with new construction is the delays. So keep talking to your mortgage professional and see when those days are. And if there's about a month or 2 window from when your rate hold ends and when you're taking possession of you're supposed to be taking possession of your new build, because there's so many supply chain disruptions, what we're seeing out there in the marketplace, my last tip for you is really just get ahead of it. Talk to your lender, see if there's any way you can secure it for a little bit longer, because of the new environment that we're in with supply chain and the delays in the new construction. So if you are purchasing new construction, the rate hold is a huge thing that's coming into play right now. So you want to make sure you're not going to be paying what the rates are, 4 months from now, and you can secure in what rates are at today.